Okay, we're doing something very, very different. There are many people who need to get a holding company, all this stuff set up. So this is something that we'll do for you. The link will be below. Also, we're getting into velocity banking and a whole different credit paradigm. That link's below as well. So let's roll off into this video today. I was watching some YouTube videos and it made me aware that I was doing something very different with my money for a long time. Let's talk about the first thing. For years, I used my credit card like a debit card. I would use it and then I would pay it off. And this is something that I did for years and I wasn't really conscious of what I was doing. And then there was something else that I did. Like typically when I make large purchases such as a car or something, I usually have the money in the bank. Very, very different. Very, very different. And one of the things that I want to teach you is you've got to redo your credit and money management habits to set yourself up for the future. Because here's the thing, everyone virtually watching this video lives in the United States of America. Living in the United States of America is going to get more and more expensive. It's not going, now, let's say we had a major crash where housing prices went down really low, the price of cars went down really low, and you know what we would have? We would have massive unemployment. We would have a very, very bad economy. So what a lot of people are hoping and praying for, the prices to come down, spells doom and gloom. Let me go ahead and give you some insights and wisdoms on why the price of things are not going to crash, they're not going to come down. Number one, the housing market. There are a bunch of people with a 2 or 3% interest rate. They got in really good. Their price of their house has skyrocketed. So now they have a lot of equity. But here's the deal. If these people were to sell their house and not get enough money to buy another house outright at the current inflated interest rates and the current inflated housing prices, they would be thrown into this market where they'll be scratching and scritching and searching for a house. And a lot of people who are in a really good position with their house, they're not going to sell. They're not going to come out of that low interest rate. So this is going to keep the housing supply down. This is going to keep the inventory levels down. Now you'll start to see, because this is one of the things that I've been really watching and looking at, and there are more and more housing properties come on the market. But this is something that I'm seeing consistently here in Atlanta. A house will come up on the market on Sunday, $1 million house. Then it would be under contract by Friday. Now let's go ahead and say a house comes up on the market on Sunday and it takes 30 days to sell. That's still a seller's market. Let's say a house comes up on Sunday and it takes 2 months to sell. That's still a seller's market. So even as more and more houses come on the market and they take longer to sell, until we get to a point where a house comes on the market on Sunday and it takes 6 to 8 months to sell, that's when we will get into a buyer's market, and that's a long way in the future. One of the things that you need to do, and this is something that I wish someone had told me, is when you first turn 18 and you get your first job, you get your first credit card, you need to redo that whole paradigm, because this is what happens, and this is what happened to me. I got my first, I was in the military, I got my first 2 credit cards. Those credit cards were maxed out within about 3 months, and I was just stuck working and paying bills, working and paying bills. And this is something that we're going to get into in the training, where you need to have a better situation in terms of your spending, a better situation in terms of how you operate with your money. So the first thing that you need to do, and this is something that no one ever told me, so I'm here to tell you. The first thing you want to do is establish a long-term emergency fund, a short-term emergency fund, and a family operating account. The long-term emergency fund is 12 months of what you make in the bank. The short-term emergency fund is $5,000 to protect the long-term emergency fund. And the family operating account is to have 2 months of living expenses in the bank. So when your bills come, you just pay your bills versus waiting until you get paid. So it's a very, very different thing. And if you start to structure your money like that from day one, when you're 18, life is going to be much, much easier. And then this is where credit is very, very important. So you get your first credit card, you should once again get your first credit card, and then you should use it and you should pay it off, and then do research on when can you ask for a credit limit increase. Typically, most credit card issuers are 6 months you can ask for a credit limit increase. There are some credit card issuers where you have to wait a year. So what you want to do is use this credit card to pay your car insurance, your gas, your groceries. Use it for everything and consistently use it and pay it off every month. And then once you're eligible for that credit limit increase, and this is why you want to start with this first card, you want to go ahead and get the most money that you can get on this first card. Then you do this again. Once again, you use the credit card, spend all your spending, food, gas, cell phone, car insurance, whatever you can, you put it all on this credit card. And then once you can go ahead and get your credit limit increased, then you do it again. Now, you do not apply for any other credit cards. Now, this is going to keep your credit reports lean and clean. And let's say you get the credit card where you can get the credit limit increased every 6 months. So after 18 months, you've got your really small credit limit increased to, let's say, 10,000. All right, now what you're going to do is go out and apply for not one, not two, but 3 credit cards at the same time. 3 credit cards at the same time. Because typically when you apply for credit cards, because here's the thing, your credit report is going to reflect that you haven't been applying for a lot of credit. You've been getting your credit limit increase, so your credit report is going to be pretty clean. So you should get all the 3 of these credit cards. Now, what's going to happen is you should go for reward credit cards. Either you get miles or cash back. I would pick travel because that's going to be way more valuable than miles in my opinion. But if you like miles, you can pick miles. And then what you're going to do is take all of your spending and you're going to put it on the credit card that gives you the most cash back or the most miles. And then this is one of the things you're going to do. You're going to pretty much put that first credit card in the sock drawer. Then you're going to wear out this second credit card, use it for everything, food, gas, car insurance, whatever you can, paying the power bills, whatever. And you're gonna use it and you're gonna pay it off. You're gonna use it, you're gonna pay it off. You're gonna use it and you're gonna pay it off. Then once you're eligible to ask for a credit limit increase, and more than likely it's gonna be a hard pull, then you're gonna ask for a credit limit increase. But because you've been using this card voraciously and you've been using it quite a bit, you're gonna be in a good position to get a credit limit increase. Then at this point, also, I should back up. Once you're 18, you should immediately start an LLC. This is something you should do when you get your first credit card. You should start an LLC and get your EIN and get your business checking set up. Now, while you're going through this process of, let's see, getting your first credit card groomed and situated, this LLC is going to be aging in the background. It's going to be aging in the background. So by the time you have your second credit card and you get your second credit increase, this aging LLC should be 2 years old. Then once you have this new credit card and once again, you're going to try to get all the highest credit limits you can get with your credit cards. This is going to be key. Then once you have your LLC is 2 years old, you're going to go in the bank and you're going to say, hey, I want to apply for a business credit card. And then they're going to look at you, they're going to look at your personal credit, and they're going to look at what you currently have. And your business cards will be exactly what you have on your personal credit, or they may actually give you way more. It just depends upon the bank and the situation. And then you're going to take this business credit card, right? And then you're going to replace all of your personal credit cards. All your personal credit cards will be paid off. And essentially what you're going to start to do is all that spending you were doing on your personal credit cards, you're going to move it to this business credit card. Now, why do we want to do this? This is going to keep your personal credit pristine and clean. So you're going to take all your spending and put it on this business credit card. And after about 6 months, you're going to go out and get you another business credit card. Also, you're going to get some more personal credit cards. But here's the thing. You're never going to use your personal credit cards. You're going to put all your spend on business credit cards because this effectively hides your utilization from your personal credit report because you're using business credit cards. So about in the year 3, you should have 3 or 4 business credit cards. And then once again, with your LLC, and you can do this with what I call a naked LLC. You have an LLC that you're not making a lot of money on, you can get business credit cards with this. Now, this puts you in the position where you have a lot of personal credit that you're not really using. Car loans and lines of credit do not impact your credit report the way the credit cards do. So you would go out and get you a line of credit in your personal name. Now, this is really, really interesting. I don't think you've ever heard this before. So you go out and you buy your first car, right? You already have your line of credit. So you go out, you buy your first car. Let's say your car is $20,000. Your line of credit is $10,000. So what you're going to do is to go ahead and get this car. Then you're going to take your line of credit and you're going to put all of it on the car loan. And then what you're going to do is pay off your line of credit. Then once your line of credit is paid off, then you're going to go ahead and put this again on your car. So this way you could get your brand new car pretty much paid off, maybe a year, year and a half. So now you have a line of credit, you have personal credit cards, and you have business credit cards, and you have a paid off car, and you have an active line of credit that you have utilized and you have paid off over and over and over again. So what you're going to do, once you got everything paid off, you're going to go to the bank and you're going to say, hey, can I get an increase on my line of credit? The bank's going to look at you and it's like, yeah, you used it, you paid it off, and they're going to bump up your line of credit. And this is how you're going to buy cars. And the line of credit is going to be really, really important when you buy your first house. It's going to be super important because now you've used it to buy a car and pay it off really, really quickly. Then you're going to buy a house, and then you're going to use that same line of credit, and you're going to do the same thing that you did with the car. You're going to use that line of credit to pay on your house, and literally you will be able to pay off your 30-year mortgage in 5 to 7 years. 5 to 7 years. So now here you are with personal credit, business credit, lines of credit, a paid off car, and a paid off house. And essentially, if you start this when you're really young, 18, 19, you'll have a paid off house before you're 30 years old. And this is the whole process of redoing how you use money and redoing your credit applications. So this is something that we'll be talking about in the training below, Velocity Banking, Mega Bank. And this is it's something that some people, some really smart people have known about for a while, but this is a way for you to use your money in a manner that keeps you in a position where you are ahead of the money curve, where you start having cars that are paid off, where you actually get your house paid off. And this is going to be really, really important. So the interest to get into these programs, the links below, check that out. And that's all I got for you guys. I will talk to you in the next one.